Take a look at the decisions being made across corporate America today. Companies are cutting costs, delaying projects, hiring more cautiously, focusing on efficiency, protecting profits, and preparing for uncertainty. At first glance, it raises an important question. Are businesses still building for the future, or are they simply trying to survive? It's a question that investors, employees, consumers, and executives are all asking in different ways, because the business landscape in 2026 feels very different from the one that existed just a few years ago. For decades, growth was the dominant strategy. Companies expanded aggressively. They entered new markets, launched new products, hired large numbers of employees, and spent heavily to capture future opportunities. The assumption was straightforward. The future would be bigger, demand would grow, consumers would spend, and businesses that moved fastest would win. Today, that confidence looks very different. Businesses still want growth, but they are pursuing it much more carefully, and that's where the debate begins. Some people look at today's corporate behavior and see businesses going into survival mode. Others see companies preparing intelligently for the future. The reality may be somewhere in between. One reason businesses appear to be focused on survival is because uncertainty has become impossible to ignore. Consumer behavior is changing, technology is evolving rapidly, economic conditions remain difficult to predict, and competition is becoming more intense. When uncertainty rises, businesses naturally become more cautious. Executives begin asking different questions. Instead of asking, "How fast can we grow?" they start asking, "What happens if conditions change?" That shift influences every major decision. Hiring becomes more selective, investments face greater scrutiny, expansion plans become more measured. Businesses focus on protecting what they have before chasing what they might gain. To some observers, that looks like survival mode, but many executives would argue that it is actually future planning. After all, a company that ignores risks may not be around long enough to benefit from future opportunities. Another reason businesses seem defensive is the changing consumer. For years, many companies relied on strong and relatively predictable consumer spending. Today, customers are behaving differently. People are comparing prices more often, looking for value, delaying purchases, and making more deliberate spending decisions. Businesses have noticed, and they understand that future growth depends on understanding these changes. That's why so many companies are investing heavily in customer data, market research, and consumer insights. They're trying to understand where demand is heading, not just next quarter, but years into the future. In other words, they're not simply reacting, they're preparing. Technology presents another interesting example. Artificial intelligence is arguably one of the biggest business opportunities in decades. Yet many companies are approaching it carefully. Instead of making massive all-or-nothing commitments, businesses are experimenting, testing, learning, and scaling gradually. Some critics see caution, others see smart strategy. Because the reality is that nobody knows exactly how AI will reshape industries. Businesses know they need to participate, but they also know that reckless decisions could be costly. As a result, many companies are balancing innovation with risk management. They're building for the future while protecting themselves in the present. That balancing act defines much of modern business strategy. Hiring trends tell a similar story. Many companies continue investing in talent, but they're doing so differently. Businesses aren't simply adding employees because growth projections suggest they should. They're focusing on skills, adaptability, and long-term value. They want workers who can help navigate a rapidly changing environment. That isn't just about surviving, it's about building organizations capable of competing in the future. The same pattern can be seen in corporate spending. Businesses are still investing billions of dollars. They're investing in technology, infrastructure, research, automation, and new products. But they're becoming more selective. Executives want clearer returns, stronger business cases, and greater confidence before committing resources. This slower decision-making process can look defensive from the outside, but many companies view it as strategic discipline. The goal isn't to avoid the future. The goal is to avoid unnecessary mistakes. Another major factor influencing corporate behavior is what many businesses learned over the past several years. Unexpected disruptions exposed vulnerabilities. Supply chains broke down, costs increased, demand shifted, and companies discovered that efficiency alone wasn't enough. Resilience mattered too. Today, businesses are building backup plans, diversifying suppliers, strengthening operations, and creating greater flexibility. Some view this as survival planning, but resilience is also an investment in the future. A company that can adapt to change is often better positioned to grow when opportunities appear. Perhaps the biggest misunderstanding is the belief that survival and future building are opposite strategies. In reality, they are becoming increasingly connected. Businesses cannot build for the future if they fail to survive the present. And surviving the present often requires making decisions that strengthen long-term competitiveness. The strongest companies understand this. They're not choosing between survival and growth. They're pursuing both simultaneously. They're protecting profitability while investing in innovation, managing risk while exploring opportunities, building resilience while preparing for expansion. And that may be the defining business strategy of this era. The world is changing too quickly for companies to focus exclusively on growth. At the same time, businesses cannot afford to focus solely on defense. Success increasingly requires balance, the ability to protect today while preparing for tomorrow. So are businesses building for the future or just surviving? The answer is that they're trying to do both, because in today's environment, those goals are no longer separate. The future belongs to companies that can survive uncertainty without becoming paralyzed by it. The companies that can adapt without losing momentum. The companies that can remain disciplined without losing ambition. And the companies that understand that resilience and growth are no longer competing priorities. They are becoming the same strategy. That's the reality reshaping business in 2026. And it's why so many companies are changing the way they operate. Not because they've stopped believing in the future, but because they're trying to make sure they're still around to